Good morning. It's Monday, the 6th of January, and this is Govindraj, Ethiraj, headquartered and broadcasting and streaming as always from Mumbai, India's financial capital. And before I start off with the take, welcome back to the first news podcast of the core report for the new year. And the take. What does 2025 hold for us as an economy and for businesses? What are the factors that will determine growth and, I guess, prosperity in the year ahead? Let me pose this question a little differently. What does 2025 not promise, and what does that mean for businesses and investments? And that leads to what economic narrative we choose to believe. Going into 2025, we were gathering the impression that the slowdown that we saw in corporate profits in the second quarter from July to September 2024 was somewhat one-off and a result of several factors from heat waves and excessive rains to elections that all held back growth. The consensus that was building up was that the new year would see an upturn in more ways than one. It appears that we may have already been overestimating a bounce back. And this is important for some strategic reasons that I'll come to. I read through two sets of commentaries put out by two economists, one from HSBC and the second from Axis Bank. And I'll refer to both because they illustrate a dramatic reset in expectations and also how to or not to interpret data. The first one says that while some consumption growth will return as it should, there is also a need for a reality check, which is that India's potential growth or the ability to grow sustainably without driving up inflation or external balances is actually 6.5% and not the 7.5% number of the last 2 years. Moreover, says the HSBC report, the bulk of the growth exuberance of the past few years has been led by the rise of the new India, a small but fast-growing part of the economy, which is 15% of GDP and is also growing at 15%, which comprises, among other things, several high-tech sectors. Now, this new India, which I'm sure you see around you, has driven heady growth in everything from mobile phones to pricey real estate and the larger premium goods segment. Now, this, of course, continues to be the case, though is showing some signs or early signs of slowing down because there is only that much premium real estate one can buy. By the way, a report by Japanese brokerage Nomura says that India is in the midst of a cyclical slowdown, and this evidence of a household balance sheet stress aligns with weak income growth and a K-shaped urban consumption demand. Remember, a lot of people were getting upset when that term was used. Essentially, says Nomura, subprime borrowers are primarily taking on consumption loans, while those better off are leveraging to buy assets, suggesting a K-shaped credit market in India. Now, to return to that HSBC report, the good news it says is that 6.5% growth is still pretty impressive in the current global order. Now, this, of course, is a narrative within a narrative, but something we can work with and park aside for now. The challenge now, says HSBC, is to maintain this level, and for that, growth needs to be more broad-based. Unbalanced growth, as we've seen in the past, it says, can lead to excesses and eventually become unstable, quoting the example of how urban consumption over the last year expanded strongly alongside thanks to an unfettered rise in unsecured consumer loans, eventually requiring the central bank, that's the Reserve Bank of India, to clamp down with heightened risk weightages, thus increasing the cost of borrowing. So to conclude, there is a problem with the 7.5% GDP growth narrative built over a 8.1% growth figure we saw last year and the general sense of a post-pandemic consumption euphoria. Then comes the next report, authored by the economists at Axis Bank around the government's second household consumption expenditure survey, or HCES. Unlike another report by the State Bank of India's economist team, which concludes, and quite predictably bullishly, that among other things, poverty in India has crashed below 5% and thus all is hunky and dory, this one expresses some skepticism. Getting into all the details can be a little weighty here, but all the reports are in public domain if you were to access or are keen to access them. Now, Axis Bank says the survey shows some trends that contradict anecdotal evidence and other data. It also concludes that respondents not being truthful in a survey is a common problem, and this is something other economists have also pointed out to me. Now, this survey, which suggests that consumption inequality has fallen, may be best used as a snapshot rather than for trends, says the Axis report, adding that these trends are nevertheless surprising and contrary to reported revenues for listed firms as well as anecdotal evidence. Speaking of anecdotal evidence, consumer products company Dabur, for example, said last week that its revenue rose in the low single-digit percentage range in the third quarter thanks to subdued demand for healthcare and beverage products. Analysts on average had expected revenue growth to pick up to 4.8% in the October to December quarter, according to Reuters, from a 5.5% decline in the previous quarter, which, by the way, was the first drop in quarterly revenue since 2020. Now, Dabur India, much like its peers in the consumer product sector, has struggled with the double whammy of increasing costs for raw materials and low consumer demand due to high inflation, especially in food prices, said Reuters. But it also pointed out that the company, or rather, it quoted the company saying demand from rural consumers continued to rebound faster than in urban regions. And this, of course, is a theme that will recur now. Interestingly, Dabur said it had partially mitigated high input costs through price hikes and by cutting other expenses, which means to me that other companies are doing the same thing or similar. Now, narratives are important. They give us a sense of direction when things are going well, but they can also confuse and cause us to project outcomes which may not be realistic or feasible, when actually one could be using the same time and energy to shift strategies and perhaps go defensive. Now, this has quite likely happened with several companies in recent months, whether they admit it or not. Now, this also is the strategic part I referred to earlier. The automotive sector is a classic case of an industry producing more products, in this case cars, and dumping them on dealers because they were so confident of demand, all the while choosing to ignore the early signals or signs of slowdowns, at least in the domestic market. The real estate market will also see some version of this recalibration. 2025 will be a year of careful moderation and calibration, even as we recover from the hangover of a 4-year party, pretty much like someone who's imbibed too much on New Year's Eve, fun as it was while the music was playing. 2025 will also be the year where we will be, or hopefully will be, more careful about what signals to look for and what to ignore. And that brings us to the top stories and themes for the day. The stock markets were down last week and 2025 will be muted. Crude oil prices hit a 2-month high. Brokerage CLSA dumps HDFC Bank from its portfolio, focuses on stocks like Tata Motors and NTPC. Foreign portfolio investors bought barely $500 million net last year, but not all portfolio investors are the same, and some are more faithful than the others. Forex reserves were down $13 billion in 3 weeks to about $640 billion as the rupee hits a fresh low. After Ford, it's time for pizza maker Papa John to return to India.
This is a call report with Govindraj, Ethiraj.
The markets were down last week. It's always a tough time to call markets when the institutional investors are on holiday. Now, this applies as much to equities as it does to commodities like oil, unless something big happens and everyone races to or boots up their trading screens. When things are not looking very good like it is right now, it's also a good time to look back. The Sensex closed 2024 with an 8.2% gain, adding about 8,800 points and peaking at an all-time high of 85,978. The Nifty 50 was up similarly about 8.8%. And this was the 9th consecutive year of growth for the indices, which have now risen about 200% in this period. Now that you've digested all of that, let's return to last week, which saw the BSE Sensex and NSE Nifty 50 and the week's last trading session in the negative. The 30-stock Sensex was down 720 points to settle at 79,223. The NSE Nifty 50 was down at 24,004, down about 183 points. So the broader markets, which is the Nifty Mid-Cap and the Nifty Small-Cap 100 indices, were down 0.3 and 0.24%. All of this is last weekend. Back to feeling good, India's domestic market capitalization, according to reports, was up about 18% to about $5.18 trillion in 2024, adding about $806 billion. Now, this made India rank third globally amongst the top 15 major markets, both in percentage and absolute terms. On the other hand, the US markets, which, as you know, we've been tracking closely and also pointing out the similar rise between the US and India, were up about 25.6% or about $13 trillion to about $63 trillion in market capitalization. So that also gives you a useful contrast. Interestingly, the world market cap rose to about $125 trillion in 2024, and the United States alone accounted for about 94% of that gain, according to Business Standard. So all of this means that 2025 will be muted, and that's something that fund managers have been saying in the last few months and with increasing intensity in recent weeks, and more on that shortly. A muted 2025 and some stocks are out of favor. CLSA Securities, a brokerage, has said that an uncertain and risky global macro environment, along with a near-term economic growth slowdown in India in the face of absolute, elevated and relative valuations, are making them forecast muted returns for the Nifty in 2025. Now, CLSA's projections or forecasts are, of course, in keeping with what other institutional investors are also saying, though the language may vary. The underperformance of actual capital expenditure spending versus expectations and rising tailwinds for affordable consumption make us favor this sector and raise staples to a big overweight. It said in its report dated 3rd January. CLSA says that after skimming for large cap stocks which have fallen over 20% from highs, it's now added Tata Motors, NTPC, Nestle and Britannia, which is the staples, to its India-focused portfolio. On the other hand, perhaps not so surprisingly to some, it says that they've removed HDFC Bank and cut their overweight in banks. CLSA says it remains overweight on commodities and insurance, while information technology, discretionary industrials and healthcare are its underweights. So, CLSA says that along with expensive bonds and currency versus global peers, Indian equity markets their valuations remain well above their own long-term average as well as their relative premium to peer markets plus bonds. All of this will keep absolute Nifty returns muted in 2025. CLSA, like others, is pointing out that the last 6 months has seen a prominent increase in the government's willingness to raise spending on welfare schemes, particularly around state elections to attract voters. And these, along with a rise in crop sowing plus good rains, should improve rural incomes and also drive some recovery in affordable consumption. It also says that after the recent pullback, they find large cap affordable consumption names trading at much lower premiums to historical averages than the premium seen in investment and capex stocks. Now, obviously, this highlights the rising consensus that public spending-driven growth is not likely to hold since capital expenditure by both central and state governments has slowed even as funds have moved towards welfare, something we've obviously all noted and discussed here on the core report in recent weeks and months. Now, all of this may at least drive a short-term shift in favor of stocks in consumption and some cool-off in the elevated valuations of investment and capex names, says CLSA. So more broadly, the CLSA says the recent correction in the market has been quite steep, and they find that more than half of the NSE 200 stocks are now trading more than 20% below their 52 weeks high. Of these, they have found about 30 companies with positive CLSA recommendations. Crude oil prices hit a 2-month high. And here's our special Energy Week segment that kicks off today, supported by India Energy Week. We will have more insights and interviews around energy in coming weeks, but for today, a quick sum up. Crude oil prices were up last week and gained for the week thanks to cold weather conditions in Europe and the United States, apart from a perceived demand uptick in China thanks to an additional economic stimulus that's expected. Oil prices edged higher on Friday and were on track for weekly gains as cold weather in Europe and the United States, as well as that additional economic stimulus flagged by China, helped push prices to their highest in more than 2 months, according to Reuters. Brent crude was holding around $76.50 over the weekend, with Brent being overall on track for a roughly 3.3% weekly gain. That's last week, according to Reuters, which also added that oil is likely to have gained some price support from expected increased demand for heating oil after forecasts for colder weather in some regions. US crude stockpiles have dropped by about 1.2 million barrels to about 415 million barrels, Reuters reported, saying that US gasoline and distillate inventories jumped as refineries ramped up output, though fuel demand has overall hit a 2-year low. So that's the figure that you should watch for in trying, or if you were trying to compute how crude oil prices could move. And finally, watch out for the India Energy Week 2025, scheduled from February 11th to 14th, 2025. That's next month, and more details and links in the show notes. Foreign portfolio investors crash in 2024, diving into those numbers. As of 24th December, foreign portfolio investors had made a net investment of barely 5,000 crore rupees in the Indian equity markets, which is less than $1 billion or just above $500 million. Contrast this with a nearly $20 billion of net equity investments in 2023. Interestingly, the debt market also saw good inflows of about $13 billion in 2024. So the outflows were driven obviously by selling, or rather high-intensity selling in some sectors, including oil and gas and FMCG or fast-moving consumer goods, and of course financials. Now, there are of course some nuances to these numbers. The larger point is of course that all foreign portfolio investors are not the same, and some continue to be for various reasons, as we'll come to. also more faithful to the Indian markets than others. I spoke with Jay Kothari, Senior Vice President, Global Head International Business and Lead Investment Strategist at DSP Mutual Fund. And I began by asking him why we saw such sharp outflows last year and what were the nuances within these numbers in the outflows, and of course, finally, what 2025 was looking like.
So as far as the flows are concerned, they've been very contrast in terms of the domestic and foreign. So domestic, you've seen almost $63 billion come in 2024. In contrast, the FPIs have been negative $100 million for the year that is 2024. That is on equities. If you look at fixed income, it was around $13 billion positive. But I think the devil is always in the details. So if you just look at the $100 million negative flow, it kind of paints a negative picture immediately when you read that number from an equity perspective. But I would urge investors to kind of look at the holistic view in terms of when you dissect this flow, it is a mixture of $20 billion, which was positive for funds, which are tracked by EPFR, which is, let's say, the India dedicated funds, which is ETF and non-ETF and active managers like us, like the UCITS and, many of the other funds which are available in the Europe, Middle East, Africa, US, etc. So which are India dedicated. So that saw almost a $20 billion inflow, which is a point to be noted. In contrast, there was a $25 billion outflow from the stock of money which has been invested through the years. So in a nutshell, if there is $1 trillion invested by FPIs in India, they sold around 1-2% this year, which is all right, which is understandable. And when this selling kind of stops, you'll suddenly start seeing $15-$25 billion every year come into Indian equities.
$20 billion that you are referring to, which is the more dedicated flows, what does that signify? How does it get broken down?
Sure. No, I think the way to look at it is that, investors like you and me abroad who kind of are looking at India investments, they are allocating capital actively or passively, right? So through funds or through ETFs or passive or actively managed equity funds like ours. So they kind of allocate capital, including the allocation funds. When you talk about the allocation money into emerging markets and then which flows into India, this is that money where people are actually investing their funds through the fund route versus a direct equity route like the pensions and the hedge funds and the family offices or the sovereign wealth funds, which have access to India or the markets on a direct basis rather than an indirect basis through funds. And that is the stock of money, which is much larger. So to give you a ballpark, out of the $1 trillion which I mentioned, which FPIs invest here, the actively managed funds are around $100 billion, including the passive, versus the $800-900 billion, which has been invested through many of the other routes. Now, from that, they must have kind of rotated back to China or any of the other emerging markets, which saw a selling from that bucket versus the fund bucket, which was positive. So net, they became negative for the year. But if one of the negative buckets kind of even becomes slightly marginally positive or reduces their selling, automatically you will see the flows kind of positive on the other side or on a cumulative basis.
And how has this trend been? So you said, again, just holding on to that figure of $20 billion last year for actively managed India-focused or India-aimed funds. How would that compare to previous years?
Again, a positive one. So even last year, it was around $7-10 billion. It wasn't negative. So the idea is that when you look at the headline number, which you all follow, the NSDL numbers, which you saw $100 million negative, my only point is that look at in composite, look at the dissection. So just the way you look at the Indian figures, in terms of the DIIs, that is insurance, mutual funds, and then direct equities. So in a way to understand is that let's assume direct equities was negative, just hypothetically, internationally. And on the other side, mutual funds and insurance were positive. So that is an important kind of aspect. And going forward, we feel that this trend will continue. India is looking kind of positive from an allocation perspective. It is underweight as far as global funds are concerned, including the emerging market and the Asia funds are concerned. So I think once dust settles down, geopolitics plus the tariff wars or, all the uncertainty and the valuations have seen a time correction, money will come back.
So in a good year, would the percentage or proportion of active and direct funds be about 10% to 20% of the total flows?
No, so the way to look at it is that the structural story of the flows, and I'm just kind of shifting gears here in terms of the domestic flows. So the way to look at it is that let's assume India is a $3.5 trillion economy, let's say $4 trillion. And if we save 30% every year, it's almost $1.2 trillion of savings every year. Indians still don't save more than 5-7% to equities. So let's say 10% moves to equities of the $1.2 trillion. It's $120 billion a year. We've already seen $63 billion this year. So this is a potential which is unleashing. So, and hence this is definitely structural and not just a tactical flow which is coming once in a while. So we feel this should continue as a trend as financialization further picks up.
So that's the domestic part. And the overseas part?
Overseas part, again, you're talking about a 100 trillion global economy and a market cap. So even if the ACWI All Cap World Index, which has 2 to 3% in India, so you can expect that is the amount of flow should, be allocated. So if on a yearly basis, if there is, let's say, 300, $500 billion, which gets allocated very hypothetically. So 2% of that, 3% of that should be allocated to India on a consistent basis. And this I'm talking about even if you were to be just neutral on India. If you go overweight, this number could go slightly higher.
So if I were to pick up on some themes, Jay, so 24, again, we are looking at calendar, the highest or amongst the highest outflows were seen in sectors like financial services, oil and gas, consumer products, that's FMCG. Now, how is that looking to you? When I say how is that, I mean, what sectors are you seeing either from a positive or negative point of view for 25? And do you see any other sector themes that are playing out?
The way we look at DSP is very clear in terms of we are kind of sector agnostic. We look at companies, as far as the earnings growth and ROEs are concerned. So we look at all sectors, but having kind of said that, financial services, NBFCs, a few of the kind of CAPEX themes, CAPEX should pick up now, second half of the year after a slow first half. And over the next 3 to 5 years, you will see kind of momentum in roads, railways, kind of water, defense. These are a few of the things which could be played out, new age sectors, which could also kind of look very interesting. So net, I think the way to look at India is a more holistic view, look at more companies across sectors. You'll find good companies across sectors, and that's what our focus has been.
And finally, the valuation question, how are valuations looking going into 25, both from or rather particularly from a foreign portfolio investor, because they are the section of investors who are more likely to sell as it appears today.
As far as valuation is concerned, so look at India and US are very similar, right? So when you look at US, it's not particularly cheap, but still money is flowing there because you see a few of the companies doing well, plus the earnings coming through. So I think one variable from an India point of view is to track the earnings going forward. If the earnings kind of are able to give you those 12, 13, 14% kind of CAGR over the next few years after a 25% CAGR over the past 2-3 years, that's something which we would focus on. Number two is that, the general sense in terms of valuation is about the perspective. If you're investing for the next 6 to 12 months, of course, it's going to be extremely challenging to expect returns because valuations are at kind of reasonable levels or maybe at averages, maybe not at the peak. But if you just kind of dissect this, one very important point, if you look at the 10-year trailing numbers for the P ratio of the market, what used to be 14 times, which we were used to seeing in 2007 to 2010, which is now 20 times, it looks expensive. But if you dissect it, only 14% of the companies within the index used to be more than 30 times price earnings multiple. Now that number is more than 50%. Which tells you that the composition of the index has moved or shifted dramatically, and hence the P ratio is looking more expensive optically. But if you kind of further dissect into index, it's good quality companies growing at kind of consistent basis, and hence you should not just look at the P and decide whether to invest or not. Look at the next 3 years, 5 years, your perspective changes.
Last question. We started with debt and we touched upon the $13 billion that we saw in debt net, whereas as compared to barely maybe $600 million in equities. So is there a sentimental consistency between debt and equity from the foreign portfolio investor point of view? Should we take away anything from that, or are these two very, very distinct categories?
The debt flows, first of all, to answer your question, yes, it's slightly different. So one can't, paint it with the same brush. But the last 2-year flows into Indian fixed income was $8 billion and $13 billion, 23 and 24, was mainly driven by the sentiment around the global bond inclusion, India's inclusion in Bloomberg and JP Morgan, and, the momentum which is coming there. So these are the allocation effects which are happening. But in terms of incrementally, when you're kind of even the dynamics in terms of the yield expectations. So if you're getting X% in the US versus India, and with the currency, with the way it's behaving, there are a lot of variables to kind of underplay before you get into that number, whether it'll be a positive or negative for the year. But net, I think if the fisc continues to remain palatable, the fixed income flows will also kind of continue in the foreseeable future.
Right, Jay, it was a pleasure speaking with you. Thank you so much for joining me.
Always a pleasure. Thank you, Govind.
Forex reserves fall. India's foreign exchange reserves fell for the fourth consecutive week and stood at an 8-month low of about $640 billion as of December 27th, according to data from the Reserve Bank of India quoted by Reuters. The reserves are now down about $13.7 billion for the prior 3 weeks and about $4 billion for the last week. Meanwhile, the rupee has now fallen to its all-time low of 85 rupees 80 paise, down about 0.3%, so marginally. The reasons are concerns about India's slowing growth, widening trade deficit, and a broad-based dollar strength thanks to a hawkish shift in the US Federal Reserve's policy outlook, and of course expectations surrounding President-elect Donald Trump's policies, according to Reuters. The feeling is that the Reserve Bank of India has likely been selling dollars via state-run banks to curb the weakness in the rupee and also to prevent a large-scale slump, says Reuters. The rupee finally settled at 85 rupees 77 paise on Friday. Papa John is coming back. And some good news on how the Indian market continues to look attractive and for pizza lovers. US pizza chain Papa John's International plans to return to India in 2025, a year later than planned, while many Western brands rethink their plans as inflation hits consumer spending, Reuters is reporting. Earlier, Ford said that it was returning to India, and so did Harley-Davidson a little before that, though through different means, though pizzas are also arguably different from cars and bikes. Papa John's left India in 2017, saying its restaurants were not able to meet the expectations of the brand and the franchise. Of course, now Papa John will compete with American brands like Domino's Pizza and Pizza Hut, who've stayed on, and of course become popular brands in India, who of course are now facing stiff competition from local and aggressive brands. A spokesperson for Papa John's told Reuters that India remains a priority and it will open its first restaurants this year. In its earlier plans in 2023, it had said that it would scale up to 650 outlets in over a decade. Papa John's said, and this is important, India is a complex market with unique consumer preferences. We are taking the necessary time to ensure our franchise partner opens with the right products and menu technology and restaurant footprint to ensure their long-term success. Papa John's has more than 5,900 locations worldwide in about 50 countries and territories. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.